Hello friends, welcome to the second part of Accounting for Partnership Firms Fundamentals. In part 1, we have discussed about the basic meaning of partnership, the definition of partnership, its features, rights of partners, duties of partners, partnership deed, its contents, then the provisions applicable in the absence of partnership deed. Now, in this video, the second part of the chapter, I am going to discuss about the profit and loss appropriation account, its features, the specimen of profit and loss appropriation account, the journal entries required, interest on loan of a partner, rent paid to the partner, what if the appropriation is more than the available profit, and then finally the difference between the charge against profit and appropriation of profit, and the difference between P&L account and P&L appropriation account. Let us start with profit and loss appropriation account. This account is basically prepared by partnership firms only. Let us go to the details of this account. A partnership firm prepares profit and loss appropriation account to which net profit or net loss as per the profit and loss account is transferred to show its appropriation. So this is the objective of preparing profit and loss appropriation account, that is to show the appropriation of profit amongst the partners. This account is an extension of profit and loss account. The way like we debit all the expenses in P&L account and credit all incomes in profit and loss account, the same way over here any appropriation to the partners out of the profit will be debited and any income from the partners will be credited. Appropriation of profit is made up to the amount available for distribution. This is going to be very important point. In case there is no profit, no appropriation is to be made. Thus, if after transfer of net loss and credit of interest charged on drawings to P&L appropriation account, the balance is a loss, appropriation is not made. But if it results in profit, appropriation is made up to the amount of profit. Features of profit and loss appropriation account. Number 1, it is a nominal account. That is what I told you earlier also. All expenses are to be debited and all incomes are to be credited. But one needs to take care all the expenses and incomes related to partners are recorded in this account, that is profit and loss appropriation account. It is an extension of profit and loss account to depict the appropriation of profit among the partners. As I have told you earlier also, this is the objective to show the appropriation of profit among the partners of this account. Number 3, it is prepared by partnership firms. It discloses the appropriation of accounting profit among the partners of the firm. The entries shown in profit and loss account are either based on partnership deed or are based on Indian Partnership Act 1932. Specimen of profit and loss appropriation account. We'll see that all the appropriations are debited and all the incomes are credited. You can see there on the debit side, the first amount is to profit and loss account. This is the net loss which will be transferred from profit and loss account over here. And if it is a profit, then we write on the credit side. Let us go to the debit side first. Let us go to the appropriations. We can see there interest on capital, partners' salaries, partners' commission, reserve. So these are the appropriations to be made out of the profits. And on the credit side, we can see there the first amount as profit and loss account. This will be the amount of net profit which is basically transferred from profit and loss account. And then we can see the only income appearing on the credit side in profit and loss appropriation account, that is interest on drawings. When we charge interest on drawings from the partners, we need to credit it over here. And at the end, whatever the difference is there, that difference will be distributed amongst the partners in their profit and loss sharing ratio. Now, what are the journal entries relating to the profit and loss appropriation account? First, transfer of profit from profit and loss account. We know that when we just close profit and loss account, if the credit total exceeds the debit total, the difference is said to be a net profit. So basically, net profit is shown on the debit side of profit and loss account. So when we transfer that net profit from profit and loss account, it needs to be credited to profit and loss appropriation account. Profit and loss account debited to profit and loss appropriation account. This is the amount generally we start the sums. Second, transfer of loss from profit and loss account. This is just the opposite of the profit. In case it is a loss from profit and loss account, the same amount will be debited to profit and loss appropriation account, and so the entry required will be loss appropriation account debited to profit and loss account. For allowing interest on capitals, partners do contribute the capital to the firm, and against that, firm needs to allow interest on capital. Now, when firm allows interest on capital, it is a loss, and being a loss, it has to be debited. So the first entry required for allowing interest on capital is interest on capital account debited to partners capital account. Partners capital is credited over here. The reason is our liability towards partner capital increases. Next, for transferring interest on capital to P&L appropriation account, the entry is profit and loss appropriation account debited to interest on capital account. Being an appropriation, this amount needs to be debited to profit and loss appropriation account. Next, for charging interest on drawings. When we charge interest on drawings from partners, it is an income, and being an income, we need to credit it. So let us see the entry for charging interest on drawings. Partners capital account debited to interest on drawings account. Next is to close interest on drawings account. We know like interest on drawings is an income. So when income is to be closed, it needs to be debited, and P&L appropriation account has to be credited. So you can see the entry over here. Interest on drawings account debited to profit and loss appropriation account. Next is for partners' salaries or commission. This is also another appropriation of profit. When we allow salary or commission to a partner, it is an expense, and being an expense, we need to debit it to profit and loss appropriation account. Let us see the entries. Partners' salaries or commission account debited to partners' capital, and then when you close this account, the entry required will be loss appropriation account debited to partners' salaries or commission account. When you transfer some amount of profit to reserve, profit and loss appropriation account needs to be debited, and that particular reserve is to be credited. Profit and loss appropriation account debited to reserve account. For transfer of credit balance of profit and loss appropriation account, that is divisible profit, will be there only if the total of credit exceeds the total of debit. If it is a profit, the partners needs to be credited. So entry will be profit and loss appropriation account debited to partners capital account. Next is liabilities of partners. It is subject to the agreement among the partners. If a partner carries on a business that is similar to that of the firm in competition with the firm and earns a profit from it, the profit earned from such business shall be paid to the firm. A very important point. No partner can carry out the competitive business, and if it happens to be, in that case, whatever the profit is earned by that particular partner will have to be paid to the firm. Another point which is very much similar to, if a partner earns profit for self from any transaction of the firm or from the use of the firm's property or business connection, the profit so earned shall be paid to the firm. Interest on loan of a partner, we know it is a charge against profit. It has to be paid by the firm. If the rate is specified, it's fine. If not, in that case, the partner has a right to receive interest on loan at the rate of 6% per annum. Every partner is entitled to interest on loan provided by him at an agreed rate. In the absence of partnership deed, interest on loan given by any partner be allowed at the rate of 6% per annum, whether there is profit or loss in the partnership firm. Interest on partner's loan is a charge against profits and not an appropriation out of profits, so it should be debited to profit and loss account. A very important point. Whichever the amounts are charged against profit, all those amounts needs to be debited to profit and loss account and not to profit and loss appropriation account. What are the entries that we are supposed to pass for interest on loan? To provide an interest on loan of a partner's, interest on partner's loan account debited to partner's loan account. Because interest on loan that we provide is an expense for us, so it has to be debited, and the liability towards partner's loan increases, so partner's loan account is credited. To close the interest on partner's loan account, we know interest on partner's loan is an expense, so when the same account is to be closed, it needs to be credited, and being this amount a charge against profit, we need to debit profit and loss account. So the entry profit and loss account debited to interest on partner's loan account. Rent paid to a partner. The firm, if uses the property of any of the partner, in that case, the firm is supposed to pay rent to that particular partner. And such a rent is also a charge against profit. And being a charge against profit, this amount also will have to be recorded in profit and loss account. Rent paid to partner, like interest on loan by a partner, is a charge against the profit and not an appropriation of profit. It is a charge on profit because of the reason that rent is paid to a partner for using his or her property for business purpose. It is therefore debited to profit and loss account, not to the profit and loss appropriation account, and credited to rent payable account. The way we have passed entries for interest on loan, similarly we are supposed to pass entries for rent payable to partner. What if the appropriations are more than the available profits? This is going to be a very important topic. If total amount of appropriation is more than the amount of profit available for appropriation, then the profit available for distribution among the partners is distributed in the ratio of appropriation to be made. Please remember over here, the ratio of appropriation to be made. It may happen that a sum is there in which only interest on capital is there. So we take the ratio of interest on capital. But what if we have more than one appropriation, like interest on capital is also there, salary is there? So in that case, the ratio of appropriation to be made. Let us see how do we find the ratio of appropriation. The first step is to determine the amount payable as appropriation to each partner as per the partnership deed, ignoring the profit available for distribution among partners. Say for example, there are two partners, A and B. Interest on capital is to be allowed and salary is allowed to A only. So we need to calculate the total amount payable to A and B, including interest on capital and salary. Then the second is to get the total of the amount of appropriation. Third step, then you can calculate the ratio of the appropriations. Whatever the total you have calculated as per step number 2, the ratio of those amounts will have to be calculated in which the profit is to be appropriated. It should be kept in mind that no particular item like salary, commission, interest on capital, etc. has priority over other items of appropriation. All the amounts of the appropriation do carry the same weightage. What do you mean by charge against profit? Charge against profit means that the amount should be paid or credited to partner's capital account whether the firm earns profit or not. We already have seen some of the amounts like interest on loan. So interest on loan is credited to partner's loan account. Rent payable is credited to rent payable account. But it may happen that interest on capital is also to be treated as charge against profit. In that case, partner's capital account needs to be credited whether the firm earns the profit or not. Whereas appropriation means that it is allowed only when the firm earns profit. Interest on partner's loan and rent payable to a partner. These are the two best examples for the amounts which are charged against profits. These are not the appropriations. Now let us go through the difference between the charge against profit and appropriation of profit. The first point of difference you can see there, nature. In case of charge against profit, the deduction is done from revenue to determine the net profit or net loss of the firm. Whereas for the appropriation of profit, the distribution of net profit for the year among the partners under the different heads as per the partnership deed. Second, where do you record this? Any amount which is a charge against profit has to be debited to profit and loss account, whereas any appropriation of profit has to be debited to profit and loss appropriation account. Third is based on the priority. Charge against profit has to be done before any appropriation of profit is done, whereas appropriation of profit can be done only after charge against profit. Point number 4, you can see the examples over there. For charge against profit, you have rent paid to partner, interest on partner's loan, whereas for appropriation of profit, you have interest on capital, salary to partners, commission to partners, or when you transfer some amount of profit to general reserve. Difference between profit and loss account and profit and loss appropriation account. The first point of difference is the stage of preparation. We know like profit and loss account is to be prepared after trading account but before profit and loss appropriation account, whereas profit and loss appropriation account will be prepared only after profit and loss account is prepared. Second, what is the objective of preparing these accounts? Profit and loss account is prepared to determine the net profit earned or net loss incurred during the year, whereas profit and loss appropriation account is prepared to show the appropriation of net profit, that is, how is this net profit distributed amongst the partners under various heads. Third, what is the nature of the items that are recorded in profit and loss account? Basically, in profit and loss account, we debit the expenses which are charged against profits and credit the income which is not the business income to determine the net profit of the accounting period. Whereas in profit and loss appropriation account, we debit the amounts which are appropriation of profit, that is interest on capital, salary, commission to partners and transfer of reserve. And the only amount to be credited over here in profit and loss appropriation account is interest on drawings. Who prepares these accounts? The profit and loss account is basically prepared by all the business concerns, whereas P&L appropriation account is prepared by partnership firms. Matching principle. We all know very well that while preparing profit and loss account, matching principle is followed, but while preparing profit and loss appropriation account, matching principle is not followed. Thank you so much. Please like, share, comment and subscribe my channel. God bless you all.